So Jim, thank you again so much for agreeing to speak with us this year. Thank you for taking the time. Just to start us off, would you mind just spending a couple of minutes giving us some background on your career journey, and what took you to Patient Square today?
Yeah, I'd be happy to. And thanks for having me. I'm excited to talk to you. And I usually give a pretty short version of this. I'll give a slightly longer one to give a little bit of the building blocks, and maybe we can build on that as we talk further. So, my at least professional career started 27 years ago now, almost 30 years ago, I guess. I joined DLJ, the investment bank, out of undergraduate. I was probably an odd person, and just to make it very relevant to people at this stage of your career. I had never had a summer job. I had never taken a finance class, never taken an accounting class. I had the good fortune that in those days, people were willing to kind of take a lark on someone who seemed like they had a decent head on their shoulders and were willing to work hard. So that's kind of who I was. I stumbled into KKR 2 years later. I never applied. In those days, you really didn't do it that way. And when now and again, they ran out of people. They had more deals than they had bodies, and they would frantically run around and try to fill that hole. And the way they did it in those days is they would ask around and ask who was performing strongly. And they went broader than just investment banks in those days. You'd go to the law firms and accounting firms and other places. And someone happened to give them my name. One thing led to another. And relatively early in my career, I landed at KKR. It's worth painting the picture of what KKR was in those days, because it's different from what it is today. That would have been 25 years ago now. KKR in those days was less than 20 investment professionals. It was one fund, one strategy. It was U.S. buyouts only. It was a small private partnership. It was the largest private equity firm in the world, although it did precisely one thing. It had a $6 billion fund, which I think in today's world, people would consider middle market. In those days, it was by far the largest private equity fund in the world. My journey from there, and I'll kind of pick up the pace here. The second thing KKR decided to do was open up a business in Europe. That would have been 23 years into its history. It decided that maybe it should diversify. It did a second thing. And three of us got that effort started. I was one of those three. I was there for almost the full first year. And that was, building a team, launching the fund, building the initial pipeline of deals. I was there for all of that. Tremendously rewarding experience for me. The first time kind of starting something. I was in London for that year. I came back home, went to graduate school. I got my MBA. I ended up missing an interesting time in the world, which was the dot-com and telecom bubble of 99, 2000. And like many others, KKR made some real mistakes during that period of time. So I graduated, having missed the entirety of that kind of period of time in 01. It was all exactly timed while I was in school. What came out of that is a view that if the firm, meaning KKR, had been deeper and smarter in its different end markets, sectors, it probably wouldn't have made many of the investments that it did. And so industry groups got formed in 01. That was, again, 25 years into KKR's evolution. That would have been, 7 years into my professional journey. I finally became a sector specialist. So I became a healthcare investor in 01. I'll digress just for a minute. It probably would beg an obvious question. I often get asked why I picked healthcare. The reality is I didn't. It was I got assigned to it, and I have 20 years of gratitude that I got assigned, because it's been an amazingly rewarding thing to be involved in, a very fulfilling thing to be involved in healthcare. And you play a very important role in that in terms of the one who allocating capital. But I got assigned. I'm happy I did. And then to finish the next 20 years in the blink of an eye, we built a pretty meaningful franchise in healthcare investing. It was a private equity business. It was a growth equity business. We did a lot of deals, deployed a lot of capital. I ultimately left in the summer of 2019. It was sort of a 2-year journey for me to leave after that long of a career, but I ultimately left in the summer of 2019. I had a 1-year non-compete, which I honored, and then last summer, meaning a little over a year ago, we launched a new firm called Patient Square Capital, and we're about a year into that journey. And I can obviously talk a lot about that, but maybe in terms of an intro, that's probably enough.
Could you tell us a little bit more about what Patient Square focuses on today? Sort of the industries, what sort of deals? I know you're involved with SPACs on the board of BridgeBio. Could you speak a little bit more about that?
Yeah, so I mean, the intent of what we do, and it's consistent with what at least I personally have been involved with for a long time, is we're narrow, meaning we're healthcare investors, and we're broad, in which we think the ways in which you can earn attractive returns in healthcare is quite a large swath of the market. And so that encompasses encompasses sectors, meaning we're pretty much all 4 corners of the healthcare market we think are fair game. We would think of that as 5 broadly defined subsectors: therapeutics, medical device, healthcare providers, and then we would think of the non-facility based healthcare service market in 2 flavors. One we would call the pharma value chain, and one we would call tech-enabled services, with one being services obviously toward the pharmaceutical market, and one largely toward consumers, providers, and maybe payers. So that's all of the above from a sector standpoint. And really that's designed to pick up pretty much all parts of healthcare. We're relatively agnostic about entry points, as long as, using our vernacular, you're beyond sort of the existential risk phase of a company's journey, and that, the kind of the proverbial 0 to 1 is behind you. Our business is 1 to hopefully a very large number. We define that basically with respect to the loss ratio. And so we would think of it as the venture capital industry lives in the world of real risk from a loss, real upside if you get it right. You can get into like type 1 and type 2 error if you want to get really wonky. We live in the world where you're not going to make many mistakes. Maybe the upside's a little less, but that could be relatively early in a firm's journey, as long as you know that you're not betting on whether the company, there's a real business model. And we're not using it in a medically defined sense, but we would think of it in terms of proof of concept of the business model. And that, at least the words that the market would use, we are growth equity investors and we are private equity investors. And we are, and I've been in both for a long part for my career, and, Patient Square is in both. You did allude to a SPAC. We did raise a SPAC. We did it back in October of last year. We're under contract. We've announced our de-SPACing target. We hope to close that in a little over a month. That predated our fund. Our focus now is on our fund. The SPAC was interesting to us because we thought we could partner with a great company, and it was exactly how it played out. So happy we did the SPAC. Our attention right now is really on our fund.
You mentioned type 1 versus type 2 errors. Could you speak a little bit more about that?
Yeah, without getting into sort of all the statistical definitions, unless people really care. I mean, really what it means from an investing standpoint is, are you concerned about making a mistake? What type of mistake are you worried about? I'm colloquializing this, but are you worried about the mistake, meaning you made an investment that you shouldn't have? Or is the worry that you have that you miss the really, really great investment? That's the error you're concerned about. And you can use that obviously from a clinical diagnosis standpoint and from a statistical standpoint. There's a lot of different uses of that terminology. It's a slight bastardization of it, how we use it in investing, but at least it makes a point. The venture model is a bit different. The way the venture model gets there, and I'm just using data, there's no judgment buried in all this. For life science venture investing, historical loss ratios, defining loss ratio is the percentage of the dollars that you deploy that ultimately are impaired. The typical loss ratios are 60%. They can overall earn attractive returns because the 40% can do pretty well. And I think mathematically how that works out is, I think it's 80% of your dollar gain in the venture business comes from your top decile of deals. And what the mentality then that necessitates, if you're going to be good at that, is your big angst is I'm going to miss the big winner, because you need the big winner because you know you're going to be wrong with some regularity. And in aggregate, you'll do really well, but you're very willing to take risk. You're very willing to be wrong. Your angst is missing the one that might really, really perform. The inverse of that is I might see the huge upside, but I want to be highly confident I'm going to earn some baseline return. And given that I don't have the huge winners to amortize mistakes, I need to be laser focused on the left tail of the distribution. And it really becomes like, am I focused on the right tail or am I focused on the left tail? My intellectual framework would be very thin, very, very thin left tail, fat right tail. Your typical orientation for a venture capitalist is going to be different from that, which is you're comfortable with a fat left tail as long as something on that the right tail is just really exotic. That's what I'm speaking to.
So you mentioned you sort of fell into healthcare. I'm just curious, what did you study at undergrad? Do you think that it's necessary or helpful to have a scientific background to go into healthcare investing? How do you get your head around the science? Yeah.
I hope it's not required because I don't have any. I joke with everybody, and this is factually true, that my last exposure academically to biology was in high school. I took AP biology in high school, and that's the last science class I've taken. I guess I took AP physics after that, but it's been a while. My background was quantitative economics, at least in those days when I was, they've changed it since then, but I went to Stanford in my undergrad, and they had two different economics majors. One was a very math-based one, and one was a much more sort of qualitative one. I was the math guy. Quantitative economics is effectively, in a lot of ways, like applied math. It's really high-level statistics. It's econometrics at a very advanced level. In a way, I don't use it at all. I mean, we don't do like sophisticated regression analysis and stuff like that. I found it useful as a framework. I think you become a bit of a critical thinker about what data is telling you. You realize how many decisions are made with data that isn't statistically significant, and how impressionistic and anecdotal the investing business can be. And so I think maybe it's something I've learned what not to do out of all that. As I found my way into healthcare and found my way into therapeutics, I found that I actually understand clinical data better than, I don't understand the science behind it always as well as many. I understand what the data is telling you better than most. So that's been useful. I bring my own lens to all that. So that was at least my background. And the statistical background has been quite useful. And I do think there's value in that. As at least it relates to your more general question. I don't think, again, there's different ways to invest in healthcare. I think you need either to have a loyalty to what you're good at, or you need to construct a team with different skills that complement one another. And to some extent, we're both of those paradigms. The model that I've effectively authored for us meaning my old firm and now my new firm, when we have invested, at least in the stuff that requires real science underpinning, which would be more, frankly, the product side of things than the services side. Although you need it in both, but I think it's more technically complicated on the product side of things. We've tended to be very management-centric as opposed to product-centric. And I can talk more about that if you're interested. We've nearly always invested in portfolios of products as opposed to single assets. So let's just take a very discrete example. If you take the classic venture model toward therapeutics is single compound, early stage, typically comes out of academia. The value that the VC investor is providing is a judgment fundamentally around the merits of the science. And we need to be able to do that, but that is not the core of what we're offering. What our approach would be, it's a management-centric thesis around that team. It's a thesis around the market. We did it in orphan drugs at one point. There would have been a thesis around targeting genetic diseases at their source. More recently, a thesis around gene therapy. So a market-driven thesis, a rock star, all-star team, and then governance appropriately and a capital base appropriately with multiple products to make science-based decisions and move a pipeline forward. What we've done, which is quite different from most, is every therapeutics deal we've ever done has gotten an FDA approval. Every therapeutics deal we've ever done has ultimately launched a drug and generated revenue. Different model than the typical venture model. Bringing that all back to your question, how do you do all that without a bunch of people with PhDs and MDs? I provide a lens. My lens is more around market, strategy, management, governance, how that all fits together. Within our organization, we have people with technical backgrounds, and specifically at Patient Square, we have a function within our firm called Patient Square Insights, which does precisely that. And you marry all those competencies together, and I think you can make pretty good decisions.
That makes sense. So just a follow-on from that. So you mentioned, you've kind of touched on this already, a good investing team has this sort of diverse skill sets. So in healthcare investing, what would you say are those skill sets? And you've touched on Patient Square Insights, and it'd be great to hear more about that as well.
Yes, I'll decompose that question a little bit. There's different skills, and then there's a little bit of I hadn't thought of this analogy honestly until right now, but in an orchestra, you need different people who play different instruments, and then you need a conductor. So there's the conductor is pretty important in all of that too. You can have wonderful musicians without a good conductor, and it's going to be cacophonous in the end. I really hadn't thought of that analogy. I like it. What do you need in totality? And then I can talk a little bit of how you pull it all together and talk a little bit more about Patient Square Insights. There's the data, the inputs, if you will, and there's no judgment about what's better. You're gonna have a really poor judgment if you don't have high quality inputs. That goes a little bit to my statistical training, like bad data. I don't care how good your regression is, with bad data, you're not going to get a very useful answer. And so you need really high quality inputs. We put a tremendous amount of energy into sort of the veracity of what we're relying on to reach judgments. And I can embellish on that, but I'll leave it at that for now. And Patient Square Insights sort of owns that. They own the market assessment, data analytics, expert networks, all the things you would do to have high quality inputs. We have a function within our firm focused on value creation of the companies that we own. We call it our TAG team, stands for transformation and growth. There's a whole aside I could go on. We can get to it if you care, about really this industry's transformed the investing industry, private equity industry, into how do you make companies grow? That's really where most of the alpha is in today's world. Rich topic there. I think the real secret is integrating that function into your decision making, so you have a view about how you make what you invest in more valuable. Sometimes you don't need to be super hands-on, but you need to have a view that this management team can do it. This management team needs help in this way to do it. These are the ways that we can help them do it. That needs to be integrated into the decision-making process. And then as you get into the judgment part of this, investing is an interesting business, and that your product is a judgment. It's a decision ultimately. That's what we do. We make decisions. the quality of your decision making defines how good you are at what you do. Obviously, the inputs matter, the integration matters. There's a bit of a disposition, I think, that is so critically important to this business, which is it's critical thinking, it's a bit of creativity, it's a bit of a contrarian streak, it's a bit of being able to make decisions with incomplete information, which is endemic to what we do. To have enough of a trust in yourself and your team and conviction and pattern recognition to with the finiteness of what we're able to do, make judgments that you're willing to live with, know when you're risking other people's money. I think there's a temperament that's pretty important, all that. So I could go a lot of different directions, but that's at least, I think, what would be most important.
The value creation piece that you brought up. As I mentioned to you before you got on the call, I worked a bit with the private equity firm's value creation arm earlier this year. What I saw was that nearly all of it was just to do with at this point, platform consolidation. That was like a lot of it. It was, you had like one big brand and you bought up these other sort of small brands around it. Is that different in healthcare? Is that different at Patient Square? What do you guys do for value creation that maybe other firms don't? And how is that different in healthcare to private equity investing generally?
Yeah, there's a bunch of points I could make. I mean, I'd say number one, I think it's really important those skills are dedicated at the industry level. I think that'd be where I'd start. And I'd say that I'll do a little bit of the chronology. Maybe that'll be a helpful building block for people. I mean, this industry's evolved, the investing industry. These private equity, you can date it back to like the 1960s. It got a little bit more institutionalized in the 70s. It's come a long way since then. Even when I got into it in the mid 90s, it was still kind of a cottage industry. In the early days, assets were cheap. There wasn't a lot of competition. Financial engineering was most of the toolkit. And the people who were in this business largely in those days were people with commercial banking, a little bit of investment banking, and maybe a little bit of legal background. It was structuring and financing companies that really is what created returns. And I'll skip over a few steps, but basically about 20 years ago, it got to the point where the simple stuff had been arbitraged away. This started its journey into industry specialization, started its journey into operational improvement. At least if you go back to my old firm, both their operations effort and the industry group effort go back to almost the identical moment 20 years ago. Have come a long way over the last 20 years. I think that's the direction this industry is heading. It's with some other little wrinkles I could go into. I think some firms initially attempted, and maybe some still do, to have just people who are great operators who can kind of sit above it all, parachute into different companies, and because they are so gifted and talented, anything they touch they can make more valuable. I'm reasonably skeptical of that model. The world's a little bit too efficient and too complicated for that. I think you need real expertise to know what to do, to have the credibility to do it with highly powered management teams. And that gets me then to healthcare. I think so you need dedicated people who've made their careers out of healthcare to do this. It's a pretty broad-based toolkit. I mean, I could throw a lot of things at you, but like, what types of things might create value in healthcare companies? Sometimes there's efficiency programs. Again, I think a lot of the low-hanging fruit is gone in that regard, although there's some that remains. Sales force productivity tends to be a big one still. That is oftentimes not a great discipline. We've used in my career, merger integration has been a big value creator for us. We've made some bold, highly strategic, transformative type acquisitions, and having the trust that you can integrate that quickly, effectively, allows you to be bold about that. It's been a big value driver for us over time. it can be an important skill set in terms of, optimizing governance, which is probably not as well understood. But I do think putting the right people around an organization so good decisions get made at firms is actually can be a surprisingly important value driver. I mean, I could ramble on, but it's a very broad set of skills, and I think they're very specific to healthcare.
Yeah. I have a follow-up question. There are a lot of like VCs and tech CEOs who like really don't like the idea of experts. Like Vinod Khosla, Frank Slootman come to mind. They have this whole spiel about like, you want to hire business athletes, you want to hire like smart generalists, experts, they're not fans of experts and so on. And the reason I'm asking is, you said at the beginning of the call that you yourself did no internships, right, while you were at university, and that back in the day, private equity firms would hire people, they'd take a punt on people who maybe didn't have a ton of experience. So I guess I'm asking just about expertise generally, like why you think it's necessary, given that when PE was really successful, they would just hire people who didn't have experience, and where you think it is necessary and when you think these VC type CEOs might be correct.
Yeah, I have an opinion on this, as you might not surprise you, and I think it depends on where you are in your career. I could answer in a very specific way or a very general way. Let me actually start with the specific, which is we do not care at the early stages of people's career whether they have a healthcare background. Meaning, let's be specific. If you're in your 20s, I don't care if you have a healthcare background. In your early 30s, I'm not sure I really care. And at my age, I don't think there's any possible way, I'm nipping at 50, that any possible way you could be effective at what I do if you don't have a long time of dedication, probably 20 years. So I think it depends on when. I think the thought of hiring a best athlete at 45, I sort of have the good luck. The world sort of passed you by, and why? Which is, it's deeply, deeply relationship driven, this business. There's a whole side I can go. I mean, sourcing is years of time and relationship building. Being selected to be the partner is years and years of relationship building. Due diligence requires real expertise, not always, frankly, to know the answers. And there's another kind of rich topic. You got to know the questions. And frankly, the mistakes you make are when you ask the wrong questions. Usually you get the right answers. You might get the right answers to the wrong questions. You need years and years of history to know that. There's pattern recognition and judgment that takes years. And I personally am of the view that like you kind of are like fumbling around in this business for about 10 years. And if you're good, it clicks about 10 years into it. And then you get better and better. And at some point you get pretty good at it. At some point you got to pick your swim lane. And I think there's value, honestly, in swimming across the pool, like across all the lanes early on. I think it creates a sort of an agile mind. It creates a different repository of ideas to pull from. I personally think I really benefited from being a generalist for a good chunk of my early career. I mean, I worked in all industries until my early 30s, and that was really valuable to me. And I don't know if the world allows for that anymore, but I personally benefited from it. But I do think you need to pick your swim lane at some point. The world's just too hard. And if you don't, if someone were trying to, I'll just be very blunt. I don't want this to come across as arrogant, but like, Patient Square is not going to lose very often to generalist firms. Because sometimes a generalist firm could have very deep industry expertise, but if they're generalist people, we're not going to lose very often. And if we do, I'm really happy we lost, because I just don't think they're going to make the same quality decisions.
Yeah, that's a very valid point. One thing you said there is, I want to follow up on that. You said that, today the world might not allow for it. Again, so, not to keep on, hammering it, but you did like no internships at university and you've had a very successful career. I'm sure like everybody watching, their mind has just exploded hearing that. It's just unfathomable that you just don't do an internship and you're not homeless like when you graduate. And you said that when you joined KKR, it was like 20 investment professionals, and we've had a few speakers throughout the year mention that private equity today is not the industry that they joined. Are there industries that you see today that are as exciting or as dynamic as private equity were when you joined? What are those industries? And do you have any thoughts generally about the way that career trajectories and so on have changed, during your career?
Well, I'd say I did, I guess, have an internship when I was in undergrad. I was a second grade camp counselor. That's what I was every summer. So I guess I did work. I just didn't do anything that, like, at least an employer would have thought was. I was camp counselor of the year. That was my accomplishment in my summers in undergrad. I didn't even know you were supposed to get an internship. That tells you how oblivious I was. So I graduated my senior year. I figured I better get a job, and I applied, and thank God it worked out. I think what's different now is these industries sort of grow up, and when they grow up, it becomes more codified, and it's harder now to take a lark on somebody, take a chance on somebody, because that person, me, who might have had a good undergraduate performance, and maybe they could tell that I was going to come in like a ball of steam, which I guess I did, with a lot of energy and enthusiasm to learn. I'd be competing against someone who had their summers all laid out in their career. They knew when they were 10 years old, they wanted to be in private equity. I didn't know private equity existed. I didn't know investment banking existed until my senior year in college. So I just was on a different journey in life. It's hard for someone like me to compete with that today. And so I think the institutionalization of this business sort of crowds out the athletes who didn't train, and so, or whatever analogy you want to use. I do think I would encourage everybody to train, because it'd be harder to pull off what I pulled off in today's world. Nearly impossible, honestly, to pull it off in today's world. I've always probably had a soft heart for the people who have a little bit different journey, and I've been kind of notorious in my career for taking chances on people with unconventional backgrounds, because I probably was one of those people. And they don't all work out, but you get some real stars that come out of that who don't come through the kind of central casting in the typical route. There's maybe a few different thoughts in your question. I didn't know this at the time. I was sort of dumb luck, and a lot of times your career is like a series of dumb luck. But I graduated from undergrad, this goes back to 1994, when investing in private equity wasn't even called that. It was still called leveraged buyouts, but even investment banking was not the path most people took. We were coming out of a recessionary period. Looking back on it, we were at least 2 or 3 years out of it, but the world hadn't kind of acknowledged that yet. It had been at least from the investment banking investing side, a pretty tough period in the late 80s, early 90s. It was not where people wanted to go. I don't have the exact data, but next to nobody coming out of my graduating class went into investment banking. I'm sure there's people I didn't count, but I only know of one other person in my graduating Stanford class who went into investment banking. I'm sure there are others, but it was de minimis. And it's a little bit become tried and true, the path less trodden. There's a real element of that. I got on a pretty good path. I hope some of it was hard work and good work. Some of it was I chose the path no one else chose. And you can sometimes shine because you chose the path no one else chose. I'm sure the fraction of people who go into investment banking coming out of most top undergrads today is a shockingly high percentage. And that doesn't mean you shouldn't do it, but it does mean it's a very institutionalized path today. And I hope really talented people, because I hope really talented people end up at Patient Square over time, and for a bunch of other selfish and non-selfish reasons, I hope really talented people do it. But you sort of do need to know what you're signing up for, which is this is a very proven path, a very competitive path, that the standards become very you need demonstrable successes to get each stepping stone. And what I don't like about that, which maybe goes a little bit beyond the scope of your question, the people who I found went into this business earlier in my career compared to the people today, it attracts a very risk-averse personality today. It's become sort of if I want to have a nice lucrative career. I don't want to take a lot of risk. Bang it out, give me private equity, safe route to glory. And it's frankly oftentimes a very poor fit for what makes you good at private equity. And so there's some people who are, I think, frankly, reasonably poorly typecast for what they're going into. And so I kind of, maybe wishful thinking on my end, but I kind of wish it would attract a little bit more of the entrepreneurial mindset and spirit, which is where this industry started.
Just a really, really quick follow-up before Ali asks the question. You know, as you said a couple times, it wasn't very sexy back then. Now it is. I was just DMing Ali. I think something like 40% of our year applied to IB. What sort of industries do you think today are the sort of like undervalued dynamic industries that are going to be huge in the future, but maybe don't get enough attention today?
Yeah, and I don't spend a lot of time personally thinking about that. So it's an interesting question. And I don't want people to think that I feel so privileged to do what I do. I feel like I have the world's greatest job. So I don't want people to interpret my comments like you shouldn't go do that. I think you should just go do that knowing it's a little bit different than entering this industry 20 years ago. And that's it, maybe it is what it is. Talent finds great industries, and this is a great industry. It's a super fulfilling, rewarding, challenging, fun career. And that's why it's a competitive path today. What is all of that and less competitive? I would need to think about that one. And instead of trying to improvise and make something up on the fly, I'll ruminate on that.
Yeah, so you sort of touched on it about risk aversion. Do you have any thoughts about career risk? How should a young person think about whether to pursue riskier options versus less risky options? What are your thoughts on this?
I have a lot of thoughts. I'm trying to think of how to make that cogent. I'd say, ultimately, like, is your entry point into your professional career. And I'll tell you how I thought about it. And it worked out well. I had some of it right and some of it very wrong, honestly. And you somehow figure this all out on the fly. And there are oftentimes I wish I had a great mentor who whispered in my ear and walked me through all this. I think it's tempting early in your career to be very brand focused. It feels very safe. And maybe there is an element of truth to that. It kind of just if you want to just know that one step leads to the next step, leads to the next step of your career, brands can help that. If you go back in time, in DLJ, which is where I started my career, an amazing firm, just in a super, super talented group of people. They've gone on to do amazing, wonderful things, small and nimble, real apprenticeship culture. But it wasn't, and it was like the maverick. They were the ones who were growing fast and gaining market share. And it's kind of a who's who of the investing business and banking business now who came out of that ecosystem. But it wasn't Goldman Sachs and Morgan Stanley and Credit Suisse and all those firms. And I maybe more than somewhat deliberately, was very attracted to that. It was like the upstart, the one who was changing the paradigm, and you worked harder and you worked better, and you weren't relying on the fact that you were you had a brand and the world came to you. You had to go to the world. I think there's something said for that. I really benefited from it. And how does that tie back into your question, which is, I think the people are tempted early in their career not to want to take a lot of career, and I certainly get why. And maybe I didn't take tremendous risk. I took a little bit more than I could have. What's most important, I think, and what did I emphasize about why I'm so happy? I'm just super happy about that choice that I went to DLJ early in my career. I worked with amazingly talented people who I got a chance to learn from. And I think, frankly, the bigger risk is not the name of the firm or the brand of the firm or how well known it is or their stature. The bigger risk is you don't get a good learning experience, because what's going to get you where you want to go largely is the people you've chosen to work with and what you learned from them. And so that's kind of what I wish I had understood better than I did. I got lucky in that regard. If I could like do it all over again, I would have done some things differently. Some things very much the same. If I were giving direct advice, which maybe I'll do that right now to students, like I would pick your job based on who you think is going to teach you the most.
I have a really quick follow-up on that. How do you evaluate the people you're going to work with? So, for example, someone in my position, Ali's position, there's a company and it's very sexy in the media, right? It's got like a lot of like on LinkedIn, they just like acquired some new, it's really good, right? They just went public via SPAC, and you know they have like very shiny credentials on LinkedIn, and in the interviews are like very well spoken, and so a lot of companies look really fantastic. But of course, like, you know, there can't be, I mean, maybe there can be that many fantastic companies, but it's unlikely. How should we try and evaluate the people that we're going to be working with without actually working inside one of these companies? What do you think that we should look out for? And what are some red flags that might be indicators that maybe we shouldn't go work at a company?
Yeah. Well, I'll start with the people side of it, which is what I was talking about before. You know, I think you refine your intuition about it, but like we as a species, and I can get pretty intellectual about this stuff, but like we have an amazingly well-honed like sixth sense about people. It was like a survival mechanism for us as a species. We're pretty good at it. And I find being pretty loyal to your instincts about that as a career matter, it's a pretty good thing. And just as you, like, we all feel perfectly competent to judge who's worthy of being our friend and who's worthy of spending our time with. We ought to feel pretty loyal about judging who would be a pretty good person to work with, and with a lot of, frankly, the same lenses to it. Some of it's a little bit different, but some of it's very similar. How do you do that? I mean, spending time with people, and I know, like in this weird Zoom world, it's harder. You don't get to. I think the wonderful as remote technology is, so much is lost. You know, nonverbal communication that you only get from being in the same room with somebody, looking them in the eyes. I think we got great instincts about that stuff. I do think being pretty thorough about reference. I mean, they're going to check you out. You should check them out. I think that's fair game. If someone was coming to join our firm, I would embrace the fact that they want to check us out. Like, I want you to be all in when you join and really dying to be here, and know in your heart of hearts that with utmost conviction that you're doing what you ought to be doing. Find people who work there, find people who used to work there who will probably be even more truthful. Kick the tires. That's what I would do.
Yeah, thank you.
So you mentioned that you went to business school, and you also have been mentioning that times were sort of different back then than they are today. What did you take away from business school? How was it for you? You mentioned that you kind of felt a bit left out of the sort of the dot-com boom, and is it the same today? You know, would you recommend you know, someone today to pursue a similar path?
I'm super happy I got left out of the dot-com boom. It was you know, people made a lot of mistakes during that period of time. It's a topic we can get to if you want. I think there's a lot of parallels to today's market and the dot-com boom, which I'm glad I lived through that period. I learned a lot from it. You know, business school is one of these things where, like, if you went, you think it was the absolute right thing to do, and you think everybody should go. And if you didn't go, you think it's the absolute right thing to do, and you think no one should go. And so it's like, to each their own in that regard. Like, I don't know anybody who didn't go to business school who has this, if I only had gone to business school. And I don't know anybody who went who has this view, like, if only I had worked for 2 more years. So, like, I'm super happy with the decision, but I'm also totally aware that if I hadn't gone, I probably would be super happy with that decision too. And I'll be very specific on what I mean now. Like, I knew I wanted to go, so going was a good thing. If I hadn't wanted to go, going would have been a bad thing. It doesn't mean it doesn't matter, but it means, like, you either know you want to do it or you don't, and you have reasons for wanting to do it. Stanford will probably hate hearing this, but I am for sure utterly convinced I forgot more than I learned in my 2 years of business school. I probably came out, at least at the day-to-day of what I did, less good at it than when I started. I still think I'm a much better person for it. So it's I think it's a good thing, but you got to know what you signed up for. what you get out of it is largely, in my judgment, is outside the classroom. It's interacting with a bunch of super talented people who come from very different backgrounds, who aren't all in that tunnel vision echo chamber of your day-to-day job, who you get to spend real time with and talk to and become friends with and challenge your mind with. And I think I am a better thinker and a better person for that 2 years. And early in your career, I probably would have been better at my day job, having worked 2 more years. Most employers tend to think that way, which I think is somewhat unfortunate. You kind of fall a little bit behind by going back to get an MBA. 20 years into it, like 18 years of work and 2 years of business school, I think gets you to a better spot than 20 years of work. How much did you really learn in that incremental 2 years of work? You got something pretty valuable out of business school. So I think it depends on it's a bit of like your discount rate or whatever, if you want to be wonky about it yet again, how you think about something like that. With the right discount rate, business school is a really smart thing to do.
Yeah, thank you. Just a really quick question. What was there like an IB career track back when you were at university? Like, what was the career path that attracted 40-50% of students at top universities when you were in undergrad, if there was one?
Banking hired way fewer people back then, like dramatically fewer people. And to put in perspective, like when I finished my, you didn't get hired like months into it, you got hired after you finished your 2 years, but only one of us went into private equity out of my analyst class at DLJ, at least initially. Some people ultimately found their way into it over time, but it wasn't like, your analyst class got cleared out and everybody went into private. Very different world back then. I know I've made that point 100 times, but this industry's kind of grown up. The feeders into the investment banking programs back in the mid-90s was the undergraduate business programs. The largest of which being the Penn, at least in the U.S., would have been fed a lot of that talent. It was you would have gotten like a handful of people out of Stanford and a handful of people out of Harvard and a handful of people out of Princeton, but like the Wharton class, went into investment banking, and so that's evolved. What it is today, I mean, I only would know through people who ultimately join us as associates. I think it's much broader based.
Was there like so for example, like a lot of people used to go to law school much more than today. I don't know if it's like, if I'm going back too far, but I know that like some of these like P&G or whatever would have like these sort of big graduate intakes.
No, absolutely. I mean, what were the big employers? I mean, I'm sure someone could like pull up the data of the class of 1994 at Stanford and tell me I'm totally wrong, but like my impression of where people went, a lot of people went to law school, a lot of people went to medical school. A lot of people went into consulting. That was a popular career path, much smaller than it is today, I'm sure, but that was a reasonably popular career path. A lot of corporate undergraduate programs. PG&E had one, Procter & Gamble had one, Xerox had one, GE had one, like it was prestigious to go to like a Fortune 50 firm, which is probably not like the hot thing to do today. If you were a computer science major, you might think about going into tech. But it was a pretty, and I was at Stanford, you gotta remember, but it was not like today. There weren't that many, there wasn't like a robust venture community, and it was very different. So it was a different, most people would have started their undergraduate career thinking they're gonna be a doctor or a lawyer. That would have been kind of, you might have evolved, that's probably where you started. And I probably started with right? We are in, you could say it rivals the 99.com bubble. I think it actually exceeds the 99 asset bubble. If you look at any objective measure of valuation, the equity markets, at least here in the US, are higher than they were in March of 2000, which you can date stamp is the apex of that market peak. And that doesn't mean the market's going to fall tomorrow. We've been above that peak for some time now. And things can run like they did in the late 80s in Japan, much, much longer and higher than you think. But stocks are profoundly, profoundly overvalued, historically overvalued. It is the most expensive market in recorded history here in the US today. It's higher than March of 2000. It's higher than 1929, before the Great Depression. There's not like the biggest mistake people made is that this time is different myth, which it's not. And when asset prices are high, it means there's one very, very simple conclusion. Prospective returns are going to be very, very low, very low. The public markets, in my judgment, are priced over a fairly extended period of time to earn negative returns. That's I think fairly demonstrable mathematically if you just want to do the arithmetic exercise. So we're in a massive, profound asset bubble. I could talk about why. I think it's largely a misunderstanding of how monetary policy works, which is probably a bold thing to say, but I think most people don't understand what quantitative easing really is and what the implications of it really are. And this view that the only reason there is a Fed put is the market has convinced themselves that the Fed matters when it doesn't effectively matter. We'll see if I was right.
Yeah, thank you. And you mentioned that you think we're in a bubble because of sort of investors misunderstanding things. Could you speak a little bit more about that?
Well, I think the view is that this trade is one-sided, which is you have the upside of market exuberance and you don't have downside because the Fed will bail you out. The connection between Fed policy, you can go, there's a very rich body of academic work on this. There's effectively no connection between monetary policy and real economic growth over any period of time. All quantitative easing effectively does is swap out zero duration non-interest bearing securities for longer duration interest bearing securities. The real impact on that of the economy is effectively zero. So I think it is all just gross misunderstanding of what the Fed's doing and what its implications are. And if you view something as one-sided, you might as well take the upside because you don't feel you have the risk. I think it's going to become crashing down on people that you do take that risk. And I think when the market starts to fall, it's going to fall hard. I can't tell you when that will be, but I'm 100% convinced it'll happen.
Yeah, thank you.
So, sort of related, this year's been an excellent year for life sciences funding. There've been a ton of IPOs, and so how long do you think this will continue? Do you think it's sort of related to this sort of market exuberance that you speak about? Yeah, how do you feel about this?
Yes, again, you can be bearish, and I am wickedly bearish about the market in totality, and you can be bullish about subsectors, stocks, companies. I'm relatively bullish, maybe more than relatively, about like therapeutics, biotech generally. It's an amazingly innovative time. It's an amazingly innovative time. Certainly in my 20-ish years of paying attention, it is the most innovative time. And we're doing things that really matter and that really affect patient health, and that I think are going to have a reasonably transformative impact on medicine. We've got the poster child for that, which is mRNA vaccines, which are decades and decades and decades of hard work, which to some extent save the world. We're still saving the world, but we're, without that, we'd be in harm's way. And there is so many countless examples when you get into gene therapy and other sectors about what we're doing that's just sort of revolutionary. And it's moving rapidly. And so it does not feel to me that we've overcapitalized the market in light of the opportunity set. And somewhat counterintuitively, even ironically, it actually feels like the market is still capital starved. There are more good companies out there that I'm talking to than there is capital to fund them. So I actually think we are still, the capital formation in life science, I think, is still catching up to the entrepreneurial zeal and the science, idea formation and company formation. I think we're still behind. And I think the market's reacting to that. And I think the returns have been good. The returns will continue to be good. I think capital's finding that market. It's a very small part of the equity market, which is why what I'm saying shouldn't come across as incongruent. I mean, you can have a spectacularly overvalued market, and a piece of it could. I'm not making points necessarily about valuations, although I could. I'm making a point about supply and demand for capital, and typically when there's a imbalance between the demand for capital and supply, you can earn pretty good returns. And if you can earn pretty good returns, it inherently means valuations aren't too high. So that would sort of be my thought process.
Makes sense. Thank you. Could you tell us more about Apollo Therapeutics? How did it come about? And do you see more cross collaboration between the US and the UK in terms of healthcare and life sciences?
Yeah, and it's our first fund transaction. It would have been our second transaction in our firm's history. First closed transaction. Yes, second announced one. So it's very important to us. We're very excited about it, obviously. The origin story, if you will, is that it was they've used different words over time, but it was effectively a research collaboration between 3 large pharmaceutical companies and 3 of the top academic institutions in your backyard in the UK. It was done to have an effective way of finding great science coming out of those institutions. The science in the UK is as good as the science here in the US. There's no benefit of arguing who's better. It's best in the world. It's not nearly as organized a market, an ecosystem in the UK as it is in the US. In the US, the investing community has been aware of that. The schools and universities are very aware of it. There's well-developed transfer offices that serve as the intermediary between the scientists and funders, and it's a lubricated market, or whatever expression you want to use. I still think there's tremendous opportunity, but it's not like you're not cutting a new trail. The UK is not as developed in that regard, which I think from someone like us is a bad thing for patients. It's a good thing for investors, and we were aware of that. I think people were becoming increasingly aware of that. What's great about Apollo, I mean, a lot of things great about Apollo, what was super interesting about it, they have 20 programs, first-rate science, as I mentioned, vetted by the schools, vetted by those pharma companies, world-class managerial talent, looking to basically catapult their journey with more capital and to turn it into sort of a bona fide standalone company. That was the role we played. How I found that opportunity, I was close to one of the very senior executives there. It's how most of these deals tend to evolve. They either could evolve through some sort of intermediated process, or they evolve through a personal relationship. I tend to flock much more to the ones that are of the personal relationship ilk. It goes back to some of the comments I made earlier about how it would be to crash healthcare investing as a great athlete late in your career. You don't have those relationships. It'd be hard. You wouldn't be the person they wanted to work with. We were attractive to them because of that model that I've talked about, where this fits it hand in glove. Multiple products, outstanding team, great market potential, great science, as I mentioned. So it sort of fits that thesis that we have. That's it. We are now the controlling investor. We've got big dreams about what it's going to come. I hope it fits our long-standing trend of we're going to get 1 or more drugs approved. We're going to launch. We're going to generate revenue. We're going to get them in patients' hands. Maybe you can flip the last 2 in sort of terms of chronology. That's the vision.
Okay, makes a lot of sense. And there's lots of parties involved. You mentioned 3 pharma companies, 3 academic institutions. how did it get organized? Who spearheaded it? How did it start? From what was the 0 to 1?
Yeah, I mean, the start, you know, I knew it was at 1 when we got there, but like the 0 to 1 was those 6 parties decided this would be an intelligent thing to do, and built a management team around that idea. And that was sort of, you know, almost 6 years of hard work. We're stepping in. It's the first institutional financing. It's sort of the coming out party for Apollo Therapeutics. But it was it's a 6-year journey to get there. We get to capitalize on, staying on the shoulders of giants with 6 years of hard work behind us. From our standpoint, how it all happened, management authored the idea of bringing in institutional capital. They were eager to have people like us, ultimately it was us, but people like us to be partners to them and help them build the company. They had some rounding out of the team to do. They wanted to have a transatlantic presence, so they're going to build out infrastructure in Cambridge, Massachusetts. They wanted our, sort of the lessons we've learned over the years about how to manage a portfolio of assets from a governance standpoint. So I think there was some lessons learned that they wanted to benefit from. And so, one thing led to another. I had gotten to know them pretty well. I was a bit of just a informal advisor, if you will. And one thing led to another, and my informal advisor role morphed into an investment opportunity for us.
Perfect, makes sense. So you obviously focus on both the sort of R&D model, biotech, pharma companies, and also healthcare services. They have a lot in common, but also, a lot is different about them. Do you think that they require a different skill set? Do you think there's a benefit of focusing on one or the other? Do you think there's more in common than people might perceive?
And this is one where most people would disagree. Maybe it's a little bit like the people who went to business school think it was a genius decision. The people who didn't think it was a genius decision. Like people who do it, I don't think there's many people who do it the way I do it. So I'm certainly going to be out of the mainstream on this. To me, I think it's been an asset to our firm. It's been an asset. The way I approach it, which maybe allows for it, is market opportunity, strategy, management talent, and frankly, that probably should go first. It should go first. Sensible value to be sent. Most things are cheap for a reason. That's pretty fungible, that framework across different paradigms. You need the right people around you. You need to know the right people to get the right insights and inputs to make judgments. A decision-making framework, pricing risk fairly, which is ultimately what I do for a living, is something I think that's fungible across the different markets. I also have the benefit of 20 years of doing all of that. If I had spent 20 years in biotech and decided I was going to go buy a hospital company, I would probably struggle with that. If I'd been in healthcare services for the last 20 years and decided wouldn't biotech be fun, I probably would struggle with that. But I've grown up for 20 years doing all the above. And so I think I've built muscle memory to do all the above. I think what's beneficial about it, to be very specific, some of it's very specific, some of it's maybe a little more metaphysical, but the healthcare is surprisingly interconnected. And I find there's insights about how reimbursement works, or how dispensing works, or how prescribing works, how the value chain and distribution and pharmacy works. I mean, I could go in 100 different directions that if all you do is biotech, you might miss. And I do think I've really benefited from that, and so I do think there's a lot of interconnectivity. You don't necessarily have to be investing in all of it, but it's harder to pay attention, understand that all if you don't have a very tangible reason to pay attention and all that. I think there's also an element of you become a hammer looking for a nail if you get too narrowly defined. Had I answered your question about biotech differently, if my view was we're in a speculative bubble and biotech and valuations are crazy, what do you do if you're a biotech investor? I know what I do. I can go invest somewhere else. And you can take that all the way to extreme, and you should be in all asset classes and all industries. I'm not sure I agree with that either. There's some element of a focus that I think is hugely beneficial. But like, when appropriately defined, I think not being ultra narrow is an asset. Market conditions change, valuations change, competitive intensity changes. So at least that's, to me, I think in us, it's been an asset.
Thank you. At a very high level, what do you think the differences are between investing in healthcare and general private equity or growth investing? Just in terms of healthcare companies, do you think it's purely a difference in information? Do you think there's a difference in sort of personality, that, certain personalities will do better in healthcare than investing in general companies? I just love to get your ideas at a high level on the differences between healthcare and otherwise.
Yeah, there's both. I think it's a good question. I think there's elements of both. I mean, I think most people who would be great investors are going to be great investors in any sector, is sort of my view. I think it comes much down to your temperament, disposition, personality type, framework around judging risk, a lot of things like that, that I think you could apply that to a lot of different markets. I'm not sure you're going to, at least in the private markets, and it's important to emphasize the private markets are quite different from the public markets. In the private market, someone needs to choose to sell you his or her stock, their stock. Public markets, the liquid exchange, you can buy it from, and you don't even know who you bought it from. In the private markets, which is what I do, people need to want to work with you. We're on their board. They're choosing to get us involved. I do think there's some very specific things then that matter in healthcare about people wanting you to be their partner. And the most important of all, and it's why we named ourselves what we named ourselves, is the anxiety people have with capital sources in healthcare is they're oftentimes very suspicious about whether they truly value patient outcomes. And whether they, I think there's sometimes thought of as a false dichotomy between profit and patients. I think in my experience, more often they work in tandem, but I think the people worry that they can work antagonistically to one another. I think if you come across the wrong way, and frankly, not only just like if you behave the wrong way, you're going to be dead on arrival as a healthcare investor. I think people are only going to work with you, at least systemically, once they know what you're like and what you're like and how you behave. If they honestly believe and either know you or can check you out thoroughly and know that you share their mission. And I am yet to meet a healthcare company, life sciences or services, whose mission isn't focused on patients. And they want to know that their investors feel the same way.
That makes sense. So how important is network in healthcare investing? Is it your primary driver of how you source investments?
Nearly 100%. Yeah, nearly 100%. It's everything. Almost. It's obviously we got to do due diligence and we got to make good decisions. But like the one thing that if we didn't have it, we're dead, is a network.
Wow. Okay. Very interesting.
And that's also, I think as people think of, I'll bring it back to the audience here. Like if you think about career path, if what you really enjoy is sitting behind a desk and thinking through great investment ideas, there might be a better way to manifest your talents than private equity, growth equity, venture, whatever, the private markets investing. Private market investing is an interpersonal job. It has to be, because someone they pick you. They want to work with you. They need to like you. They need to trust you. And you don't have to be a massive extrovert. I don't think I am a massive extrovert. Myers-Briggs would say I'm an introvert. So you don't have to be a massive extrovert, but people need to want to you need to at least get something out of spending time with people. You need to be willing to build a network. People need to feel like they could work well with you. And that needs to be something that you're excited about. Like if you're entering your career, you need to be excited about that being part of your job over time. Like there's parts of our firm that you don't need to have that, some of the diligence functions where you're much less externally facing. But if you want to have like the role I have, that's a really important part of what you do. It's frankly probably the most important part of what you do.
Very interesting. Very interesting. And it makes sense. You mentioned earlier that you think there's a lot of value in kind of eventually picking your swimming lane. And one of the things I guess you build up through specialization is a network in a field, right?
That's right. That's right. I think you build three things, to be very specific. You build a network, you build knowledge, you build judgment, which is, I think, what makes you good at this. Mm-hmm. And you need all three, and you need time.
Mm-hmm. Makes sense. So, given your tenure in healthcare, what do you perceive to be the key opportunities and challenges in the industry over the next decade?
That's a big open-ended one. I'm obviously very bullish on what's happening from an innovation standpoint. As bullish as I've ever been, and just frankly excited to be involved in all that and help push that forward and fund it. I think we're going to end up with very happy investors and even happier patients and their families. So that's you get pretty excited to go to work in the morning if that's what you get to deliver for everybody. So that's certainly the if you want to do like the SWOT analysis, that's the opportunity, the upside. The risks, obviously you could be wrong about all that, but the risks in healthcare tend not to be, if I'm a really massively generalize, you more often than not get the volume side of the equation right. If you do it the right way, you're going to be wrong a lot. At the micro level, on the macro level, you're going to be right about innovation. Pricing is usually the pitfalls of healthcare, which I know is a topic we're probably going to run out of time on, but an important one. At least depends if you're thinking about services or therapeutics. The mistakes people made on therapeutics is they back technology that doesn't work or science that doesn't pan out. We tend to have a different approach. It's a more de-risked approach, and we're going to make mistakes, but our companies in aggregate aren't going to be mistakes. Overall, in healthcare, the mistakes made tend to be pricing. And I think we live in a world that has funding challenges everywhere you look. Consumers are strained, employers are strained, governments are strained. Governments are all this, they're despite the behaviors of the last couple of years, funding fiscal stimulus throughout COVID, budgets are in bad shape in most industrialized countries. Large deficits, large national debts, real funding strains. And these are long-tailed liabilities and long-term challenges. But we put a tremendous amount of energy thinking about what the implications of things like that are in terms of how we allocate capital as investors. And we're going to run out of time, and I'm unfortunately not going to have the ability to go into that in great detail. But I think that is systemically, it's probably a long-tailed liability, but systemically the biggest risk.
That makes sense. Last question on healthcare, and then we have a few sort of more broad questions for you. Do you do any angel investing, and are you interested in sort of earlier stage companies?
Yeah, and I do. I'm going to run out of time, unfortunately, just in a few minutes here. So we'll get as far as we can get, and I'm happy to take a second bite at this if it would be helpful to you and the students. On the angel side, I do a decent amount of it personally. Obviously that doesn't fit within the purview of Patient Square Capital. I did a decent amount of it personally at my old firm. Not huge dollars, but it's it's a way to build to stay involved with things that you find interesting and important. We have obviously compliance protocols that are important to make sure that you're not doing anything that is inappropriate from the standpoint of the people who are invested in our fund. And so anything I do personally needs to go through our compliance program and be approved. I have a decent number. I have a reasonably a number of investments that it's performed over time. It's earned returns that been rewarding personally, and that I'm proud of. Been involved in some companies that have done some important things. What I find interesting about it, and it's another maybe way to challenge the mind, you want to get deep into the detail and bog down in minutia. I usually find elevating is what's most important. The earlier you go, the less minutia there is to bog down in. And it kind of sometimes forces you to focus on what really matters. I've been I've been a bit repetitive throughout this about how important market strategy management is. Early, that's all you got. And I find that like it makes you focus on that. And if you get that right, you tend to do pretty well.
We have a couple more questions, but we know that you have to dip in a few minutes, so we'll do them as like a lightning round if that's okay.
Perfect.
You said that networking is one of the most important parts of your job. Do you have any advice for how young people should go about building up like a very productive and helpful network?
Yeah, I don't think there's any answer other than just like perspiration. It is just, you got to make it a priority. And I know early in your career, you got a lot of things on your plate. It's a labor intensive job early in your career. Probably stays a labor intensive job. It's just what you do changes a bit. I find people are willing to meet you. They're kind of excited. Like people are willing to, like, even if it's a mentorship like relationship, people are willing to meet you. I know I have been. People are willing to introduce you to other people. And I find if you just sort of make it a point, you don't want it to feel like it's a process. It needs to be authentic. But if you go meet 50 people a year, 20 years later, you know a lot of people. And I'm not telling you like 50 is the number, but like it's sort of like you do anything systemically long enough, you know a lot of people. And so I think it's a bit of just like, it's the hard part maybe is it's a little intimidating early in your career. And, why would a 50-year-old want to spend time with lowly me? I think you'll surprise yourself. As long as you're authentic and eager, and, I think people would be happy to do it. You're going to probably need to accommodate their schedules, but I think they'll be happy to do it.
Yeah. What is the most undervalued life experience that you think young people don't give enough weight to?
Failure. Good to fail, actually. It's good to fail early when it doesn't matter very much. But yeah, it's and I'm happy I haven't done it that much to some extent. I'm also happy I've done it a little. You learn a lot. That's another, maybe it adds to the point I made earlier. I mean, like most people who end up going investment banking, private equity, like everything's worked perfectly their entire lives. And you suffer from that a little bit. And I know that's the lightning round answer. There's probably a longer answer.
In the students that you encounter?
I don't encounter students that often, honestly. By the time we would employ people, we did a little bit of it directly out of undergrad. Typically, people would have had their investment banking time, so they're a little bit beyond that stage, not a lot. I see what I really wish there was more of, and I don't want this like, I don't want to be like, maybe I'm prone like the world was so great, now it's terrible, and it's none of that. Like I think there's, frankly, a lot of ways this is better, the fact that this industry's grown up, but like I wish there was a little bit more entrepreneurialism in people, at least who come into this industry. I wish there's a little bit more of a view that they don't have it all figured out. And like I'm still actually relatively early in the journey of private equity. And maybe there's things I can contribute. And maybe there's a thought I have that they haven't thought of. And maybe there's a way to approach a challenge that they haven't thought of. And like, I felt empowered to do that. Maybe personally, at a firm, at least at that stage of its journey, allowed me to do that. I wish there's more of that.
Yeah. And then final question, do you have any non-career related life advice for the students who are going to watch this?
Non-career related life advice. Yeah, I mean, I would have the same life advice pretty much anybody would give you, which is, this is not, I could put thought into this and refine it, but like, I think it's often worth thinking about like I mean, you're so far away for no one thinks about like later in my life, when like the end is closer at hand, what would I value and what do I want to have accomplished and how do I want to have spent my time, and work backwards a bit. And because regret, the world's worst emotion is regret. It's like you torture yourself over regret. And as it relates, then let's tie it back to what we're talking about. Although I don't go into things that are probably beyond like the scope of my expertise. The career path we're all choosing, or I've chosen, and it sounds like people who are going to listen to this likely are choosing, is going to take a lot of your time, and it's going to inherently crowd out other things. With a real opportunity cost to that. And you got to know what you're signing up for and why, and think that's valuable, or you're going to be pretty miserable at some point in your life. So I would probably burden people with thinking that through. And is that what you really want? I'm super happy I did it, knowing eyes wide open about what I gave up to do it. And it's not about net worth. It's about like a fulfillment that I get from it that's been very rewarding to me. But I do think it's worth challenging yourself about that.
Well, thank you again so much for agreeing to speak with us, Jim, and thank you for being so generous with your time. Really appreciate it.
Absolutely. Thank you both. Good questions. Take care.